Two big topics, one show this week. Where do your federal and state dollars come from, and where do they go? And what was the one last trick that the state legislature had to shift school funding away from the state and onto the backs of cities? Stay tuned and find out.
This is the Calimesa Insider Podcast, the original Pass Area City podcast, focusing on the ins and outs of your city government at work. And now, here's the host of Calimesa Insider, City Manager Will Kolba.
Hello again, everyone. Welcome to the program. It's so glad to have you this week. And it's been a crazy month. It's hard to believe. I feel like we're already done with 2025, and yet we're only done with January, and yet we're still sitting here in January. Now, it's the last day, but we're still sitting here. So, it's been a heck of a run so far in 2025 with everything that we've had to go through with power outages and fires and things like that. So hoping that February has a lot more positivity in store for us going forward. I did want to remind you that we will be out of pocket next week, so there will not be a show. I will be at the Cal City City Manager Conference. And I'm going to report from there. I'm going to do some short videos on our social media. So be on the lookout for that. Make sure you subscribe on Instagram and TikTok if you don't already to catch all of that content. Just a quick update for you before we get into our main topics on a couple of things. First of all, the senior meal program. I've talked about that on the program in the past. Unfortunately, or fortunately, depending on who you are, but I know there's a lot of people that relied on our to-go meal program or grab-and-go meal program at the senior center. That has ended, and it will be, or at least temporarily. We don't know if it'll come back, but it might. It still might come back, but it is suspended for now, and we're going to have in-person meals starting on Monday. So if you do watch this and you do take part in that program, just keep that in mind. There's been notice given to the people that participate in the program, so they should be prepared for it, but I'm hoping that it's not too much of a disruption, and we hope to see a lot of people at the senior center to be partaking in the in-person meals. So just stay tuned for that. The next city council meeting is this Monday, and so hopefully you can be there and check it out. Couple of items that will be on the agenda. We are going to be appointing two members of the city council to the 2x2x2 truck route committee. And the reason it's called that is because you have two members from Calimesa, Beaumont, and Banning. This comes at a request from the city of Beaumont, who just recently completed a truck route study. And so they wanted to talk to their neighbors, both Banning and Calimesa, so that they can understand what the impacts are and hopefully maybe have everything sync up and work together on that. So two council members will be appointed for that. And then the second main topic in the meeting will be the mid-year budget updates. That'll be a presentation given by our finance director, Celeste Reed. So those are always interesting items, and it's very timely because I've been talking about taxes. I'm going to talk about that more in this episode. So speaking of which, let's get to that. So again, that's before Monday, February 3rd, 6 o'clock at the senior center will be our next city council meeting. So last week, I talked quite a bit about taxes and how kind of the flow of money works and all those kind of things. But I think one of the things to keep in mind is that when I was showing that and I did that, we talked about property taxes. So I did want to follow up on a couple of things, clarify a couple of things, but I also wanted to take a little bit closer of a look at federal and state taxes as well. So I'm started with this chart. This is a chart I showed last week, but I just want to clarify something on that because you're going to see some pretty drastically different numbers, especially when it comes to per capita revenue and spending at the federal and state level. It's going to differ quite a bit from this number. So for example, you're seeing a number of $1,724 for federal income taxes. So this is based on the median income level in Calimesa and how much that particular person, if everyone was subject to the median income in the city, the median household income in the city. I basically just took that, multiplied the number of households that we have, and then divided it by our population to come up with per capita numbers. So that's what this is. So because you're going to see, like I said, you're going to see some very, very drastically different numbers when we look at the state and federal budgets. Okay. So I just wanted to prepare people for that process. So when we talk about federal money, these are the different federal pots. And so when we're talking about that, even at a level of this median income for Calimesa, you're still talking about 46% of all the taxes you pay go to the federal government. And when we talk about federal government, we usually think about protection. That's usually the thing that comes into mind, national defense and that kind of thing. So these are the different pots that get paid into the federal government. But when you look at it from a revenue standpoint, about half of the money comes from individual income taxes. So we're talking about not just on wages, but we're also talking about capital gains for individuals, things like that. Non-corporate income, which is 11%. And then a big part of the federal budget is Social Security and Medicare taxes. And so in the fiscal year 24, the federal government took in almost $5 trillion, which comes out to about $14,200 per capita, which means per person. So you take that $4.9 trillion, you divide it by the population of the United States, and that's how you come up with that number. So other income and taxes, 5%, probably things like tariffs, that kind of thing. But you can see that, over 80% of the federal budget comes from income taxes and the Social Security and Medicare taxes. So huge, huge numbers. And so now where does that money go? So you would imagine that since a lot of it goes to the Social Security and Medicare tax, you would have a big part of the budget being paid towards Medicare and Social Security, which you do, 32%. It's a little bit lower than the percentages that we're talking about. However, if you look at the top line number there, these are federal expenditures of $9.7 trillion, $28,000 per capita. $28,000 per capita. So remember when I just said earlier, if we go back, I'll go back one slide real quick. When I said we're talking about the per capita numbers, if about half comes from individual income taxes, that means it's about $7,000 per capita. But remember, I said that the average household here, or the average per capita based on the household median income in Calimesa, only pays $1,700. So that just goes to show how lopsided the tax system is in the United States. It is known as what is known as a progressive tax system. And so I'm not saying that's right or wrong. I'm just saying that's what it is. So if we fast forward back to, I'm going to go back one to the spending. 32% on Medicare and Social Security, divided up pretty evenly. 13% on national defense. 12% on net interest, which is basically the interest on the national debt. So over 10% of our budget. So if you figure 12% of a $9.7 trillion, that's just about $1 trillion right there. So $1 trillion a year going towards interest, 10% to health, 7% to income security, only 2% to transportation. And then 1% on international affairs. That always seems to be a big focus in national politics, but we're actually only talking about 1% of the actual budget. So some of these things are spent directly by the federal government, but a lot of it passes through to states. So when we look at state budgets, you'll be able to see that. So as we turn over to the states now, you'll see that there's various income sources that come from the state. But one thing I do want to point out in the sales tax numbers, I'm going to focus in on the sales taxes for just a moment here. So about a little over half of the sales taxes go to the state. So it's divided up among state and local agencies. You can see about how much the city of Calimesa gets. Now, when I show a chart showing the actual breakdown of every taxable dollar spent, if you get $1 of sales tax revenue, how that's divvied up, it's going to be a little bit different. But you notice we see City of Calimesa gets $150, other cities get $93. We'll get into that a little bit more when I talk about sales tax specifically on another episode. So we'll talk about sales tax specifically, but I just wanted to show that not all of it goes to the state and not all of it goes to the cities either. It's a little bit of a combination of all those things. So you see the different sources here again. So as we move on to the state budget revenue sources, you see that about $451 billion almost was spent in the state. Only 47% of that came from the general fund. Another 18.6% comes from state special funds. So what that is basically special fees or taxes that are passed either through initiatives or other sources that can only be spent on specific things. We have the same thing here in the city of Calimesa, where we have our general fund, which is basically your discretionary spending, and then you have special funds that can only be, there's special sources of revenue that can be only spent in a certain way. Then 34% of the money comes from the federal government. So if we focus in on just those state general fund and state special funds, these are the revenue sources. So a high reliance on individual income taxes at 41%, followed by sales and use tax of 17% and corporate income tax of 15%. And then 27%, again, additional types of taxes, cigarette taxes, liquor taxes, things like that. There's a bunch of different types of fees and taxes that go in. And again, mostly can be used for special purposes. So how does the money get spent? So 39% of these, again, these are the non-federal dollars. These are state-generated dollars that we're talking about here, spending about $7,500 per capita. We bring in about $7,300 per capita. So there's a little bit of a deficit there, some reserve spending happening in the fiscal year. Another big chunk of that, 27% of through K-12 education, which I'm going to talk about a little bit more in this episode. And then other 8% on higher education. So we're talking 35% on total for education, only about 6% on transportation. Another thing that always comes up is environmental protection, natural resources, water, EPA type stuff. That's only 4.5% of the budget. So again, it's a thing that gets a lot of attention, but in the grand scheme of things, not a lot of the money is being spent on that kind of thing. And if you look at the federal money that comes through, and again, a lot of the federal money has federal rules, so it's very restricted on how it can be spent. And the state largely becomes a pass-through. So they get this money, the feds say, this is how you spend that money, and here's where it goes to. Interestingly enough, we talk about federal policy in schools, only about 5% of the money that we bring in from the federal government goes to K-12 education. Another almost 5% goes to higher education. So about 10% of total on education on federal dollars. So again, a significant amount of money, about $15 billion, but it's in the grand scheme of things, when you look at it as a whole, not as much as you would expect. So, a lot of these things are, health and human services, a lot of social services, things like that. So that's a big focus from the state government, both on local dollars, which when I say local, I mean state generated dollars, as well as federal dollars. So how do we compare to other states? So I kind of listed out some of our three major non-federal revenues, our three largest ones, how much of our total revenue comes from the federal government, and then how much is our non-federal spend per capita. So these are numbers that I've already showed, but I did want to show it compared to other states. So what does Nevada look like? So Nevada has gaming, is famous for not having an income tax. A lot of their taxes are driven by the hospitality industry. So their biggest source of state revenue is sales tax. And a lot of that is generated by outside people. So people coming into the state to spend their money. Gaming taxes, almost 20%. Business taxes, 13%. Again, these are taxes that are, related. A lot of those are related to the hospitality, not all of them. And as industry moves to Nevada, it's shifting away from that a little bit. Gaming tax probably used to be a bigger source of revenue maybe 20, 30 years ago as compared to today, because Nevada has really grown in population and has diversified its businesses, but it still has a huge reliance on the hospitality industry in the grand scheme of things. Interestingly, only 31% of their money comes from the federal government, But the state does spend a lot more per capita than other states. Again, when you have a lot more money coming in, you can spend more money on your people without them feeling the burden of it. So it's an interesting dynamic there. And again, it does make, having that gaming and that hospitality and that tourism driven economy that Nevada has, you do very, very well in good economic times, but you get hit really, really hard in bad economic times. So they're going to have more even wild strengths, even than California, who's heavily reliant on income tax. Another state, one of our neighbors is Arizona. So they get a big chunk of their money from sales tax and, interestingly, income tax. But as you can see, though, they get more money from the federal government, but they spend a tremendous amount less per capita at the state level. What that tells me is a lot of their focus and a lot of their funding for government services is focused at the county and city level. So it's not like people are paying a tremendous amount of taxes less. They might be paying less taxes overall than, say, here in California, but a larger chunk of that is going to the local governments, the cities, the counties, versus coming from the state. So just, again, another way to skin the cat, so to speak. Oregon is famously known for having high income taxes because they have no sales tax. So 68% of their state revenue comes from income tax. Another 15% comes from business taxes. So instead of that cost being put on the consumer for sales tax, they have a gross receipts tax, which is what a lot of cities do for their business licenses, for example. So Calimesa does not do that. Our business license tax is a $24 flat tax for everybody. Doesn't matter what your gross receipts are. But a lot of cities do have a gross receipts business license tax, and so they do that at the state level. Another big revenue source for them is licenses, but 68% from income tax is a huge number. Federal government spending as a total is similar to ours at 36%, and their non-federal spend per capita is $9,800, so that's on the high end as well. And finally, just for reference, I wanted to talk about Texas as well, because that is always known as a popular destination for people that are leaving California. So again, another non-income tax state. So heavy reliance on sales tax, license and fees, and interestingly, motor vehicle sales. And they have a lot of the 34% of the revenue, just like California, comes from the federal government. And again, they spend a lot less per capita as a result from the state level. But again, their sales taxes are higher than here in the sense that they tax more things. So the rates are very similar to what we see here in California, but they tax many more things. Services, for example, a lot of services in Texas are not exempt from sales tax, whereas almost all services in California are. And so that in the end, also their property taxes that we talked about last week are very, very high. So those are just some of the things that are different. So I guess the point here is that trying to compare state by state can be very difficult because the mix could be different. But again, the control of the purse strings is really what drives policy. So whether it's the federal level or at the state level, the more money that is driven from the state, and they can dictate more because they can say, if you want our money, you have to do this. And that is how the federal government controls a lot of things. The federal government doesn't actually have a lot of statutory authority because remember, the 10th Amendment says anything not vested in the federal government goes to the state government. So the way that they get power is they say, here's the money. If you want it, you have to follow our policy. And that's largely how policy is driven. So there are things that are in the purview of the federal government, like immigration, for example. That's a big hot topic. That is clearly in the purview of the federal government in terms of enforcement. But there are a lot of other things that they want to have policy control over, and the way they do it is through the purse strings. So again, just a lot of dynamics there. So a couple of things from last week's show that I just wanted to follow up on. First of all, education funding changes. So interestingly, I mentioned that the shift from the local governments controlling school funding to the state was generated a lot by Prop 13. But what happened though too is that the state had to take over, had to even out educational funding over time, and that does put more pressure on the state. So SB 90 in 1972 was passed because there was a large disparity between school funding and spending per pupil, since schools were largely locally funded. SB 90 limited how much money school districts could receive per pupil to cut down on this disparity. And this resulted in spending cuts in wealthy districts and state subsidies for poor districts. And this is the first time since 1910 that the state began taking a larger role in school funding. So that was kind of the start of it. Then kind of on the heels of that, you had a court decision, Serrano versus Priest. And so this 1976 California Supreme Court decision declared the existing system of financing schools unconstitutional because it violated the Equal Protection Clause of the state constitution. The court ruled that property tax rates and per pupil expenditures should be equalized, and that by 1980, the difference in revenue limits per pupil should be less than $100. This is called the Serrano band. This allowable difference in revenue limits has subsequently been adjusted for inflation. In equalizing funding, districts are divided into three types: elementary, high school, and unified. And they are further divided into large and small districts to ensure that appropriate funding comparisons are made. And special purpose or categorical funds are excluded from this calculation. So the court ruling led to a decision to an assembly bill to counteract that. So the California legislature, in response to the Serrano Act, or the Serrano decision, passed AB 65, creating an annual inflation adjustment based on a sliding scale in order to equalize revenue limits among districts over time. So higher inflation increases were provided to districts with low revenue limits, with lower and occasionally no inflation adjustments for high revenue districts. And then, of course, there was Proposition 1998, passed in 1988, and this established the minimum funding level for schools and the community colleges. So this funding requirement is commonly called the minimum guarantee. The state calculates the guarantee by comparing three main formulas or tests. Each test takes into account certain inputs, such as state, federal, general fund revenue, per capita personal income, and K-12 student attendance. These inputs often change after the state adopts the budget, and in some cases, results in significant increases or decreases to the guarantee. The state can choose to fund at the guarantee or any level above it. It can also suspend the guarantee with a 2/3 vote of each house of the legislature, allowing the state to provide less funding than the formula required that year. Now, 2 of the 3 tests build upon the level of funding that the state provided the previous year, meaning a decision about funding in one year can change the minimum requirement for subsequent years. State meets the guarantee through a combination of state general fund and local property tax revenue. And that's the key. And the timing of that's important, because remember last week, I talked about ERAF. ERAF started in the early 1990s. This was passed in 1988. So the less amount of property tax revenue that goes to the schools, the more the state needs to make up, but also vice versa. So Prop 98 has really been the main primary driver in the fact that the state has had to there's been more pressure on the state. And in turn, what they did was they actually then took monies from cities and counties and gave it to schools through the ERAF shifts that I talked about. So if you haven't watched last week's episode, you should. It's must-see TV so that you can catch up on that. Another thing we talked about when we're talking about disparities between different people, especially seniors, and how much they pay for property tax and their assessed values, were based on 4 different propositions. So the first one is Prop 60, and that was passed in 1986 and allowed homeowners 55 and older to transfer their assessed value from one property to another within the same county as long as the replacement property was of equal or lesser value. Then in 1988, Prop 60 was expanded to allow transfers to other counties that authorized such transfers. So 10 of the 58 counties in California opted into this, including all the Southern California counties except for Imperial County. And then in 1990, Proposition 110 added individuals with permanent disabilities to those eligible for Prop 60 and 90 transfers. And then finally, in 2020, Prop 19 allowed assessed value transfers to anywhere in the state. So it just basically said any of the 58 counties you can do it, and expanded the number of times you could transfer properties up to 3. Previously, it was only 1. And so this effectively replaces Props 60, 90, and 110. So another big topic that has impacted the property tax and how cities operate and function were redevelopment agencies. And redevelopment agencies were largely funded by what is called tax increment. So what was an RDA? And I say was an RDA, and that'll be important later. Redevelopment was a process authorized under California law that enabled local government entities to revitalize deteriorated and blighted areas in their jurisdictions. So redevelopment agencies developed a plan and provided the initial funding to launch the revitalization of identified areas. In doing so, redevelopment encouraged and attracted private sector investment that otherwise wouldn't occur. Redevelopment activities created jobs and expanded business opportunities, provided affordable housing, and improved infrastructure and public works. And they were established right after World War II in 1945. So this was done, this is how they actually functioned. This was done through buying private property for resale for redevelopment purposes. They had the ability to use eminent domain to acquire that property. They collected property tax increment in order to finance the redevelopment program and activities, and they could issue tax increment bonds. So they could issue bonds against that tax increment that's described there. So how does that work exactly? So you would identify an area within the RDA, and usually RDAs were done by cities and counties. So the city of Calimesa did have an RDA. And so you would establish an area. So let's say downtown. Downtown is part of a redevelopment area. So all those properties are identified, all those parcels are identified, and they look at the assessed value as of the date that the project area is established. Then, in subsequent years, all incremental value after the establishment of the project area goes to the RDA. This is both the 2% growth per year as mandated by Prop 13, as well as any improvements or sales. And the taxing agencies receive the same amount from the year. It's called freezing of the assessed value. And I'll give you an example of how that works in a moment. But over time, obviously this hampered other taxing entities that were receiving funds because, again, we talked about the city only receives 30%, but yet the RDA receives all of it. They receive everything over and above. So a lot of agencies would experience, no growth within those areas. So let's look at what that actually means from a dollars and cents standpoint. So these are actual dollars in Calimesa. So the current assessed value for all of our redevelopment project areas, and we have 5 in the city of Calimesa, was just under $831 million. Okay. The assessed values when those project areas started was about $115 million, meaning that there's about $715 million of assessed value that goes to the RDA. So what does that mean? So first of all, that the assessed value, you take 1% of that 115 million, that's $1.15 million. And that goes to the regular distribution of sales tax or property tax, Now, in future years, as that $830 million moves up, that $115 million number stays the same, which means that 100% of the growth goes to that assessed value for the RDA. So then the RDA gets the rest, which is about $7.15 million, and it all goes through the RDA. Okay, so that's the default setup. But again, one of the things that I talked about was the fact that with school funding changes driven by SB 90, AB 65, and ultimately Prop 98, this became a attractive vehicle to finance infrastructure because it allowed the redirection of the property tax to RDAs, which could fund infrastructure and economic development programs, right? And it wasn't a detriment to the schools and that's a key thing, because the detriment to the schools, because Prop 13 essentially required the state to increase school funding, right? I mean, if you think about it, because for every dollar that goes out from property tax, the state has to make it up. So the schools are still made whole in those scenarios. So the RDAs did not necessarily hurt schools. So, in addition to shifting funding away from cities and counties, though, the state legislature attempted 9 different times to redirect RDA funds to the ERAF. Okay. So, which we talked about before, and this led to both voluntary and mandated pass-throughs of RDA tax increments. So we're going to look at that here. And sometimes it was out of cooperation. So basically the RDA takes money in, or at least it's designated for the RDA. Then you have all these pass-through agreements, and these are agreements that were made directly between the RDA and these different organizations. So as you can see, the Summit Cemetery District, the Beaumont Library District, the San Gabriel Pass Hospital District, and the Copper Valley Water District all got 100%. So they were not impacted by RDA. But the school districts would only get a fraction of it, between 40 and 50%. And the reason for this is because, again, they would be made whole by the state, because if you just pass through everything, you really don't have any benefit of the RDA. So you have to have a lot of that tax increment, right? But because we knew that the state was going to make up for that, that's why it wasn't detrimental to the schools. So let's look at graphically what that looks like. So with no RDA, 100% of that 7.15 million I talked about earlier goes to the goes to just the taxing agencies like normal. But with the RDA, you had a division of that $830 million the total, that value, only 1.15 million goes to the taxing entities, and $7.15 million goes to the RDA. But with all of these pass-through agreements and statutory agreements that we're going to talk about in a second, this is what it actually would look like. So this is actually how the money broke down to the redevelopment agencies. But then on top of that, in 1976, the state passed legislation requiring that 20% of tax increment be used to increase, improve, and preserve the supply of low-income housing. So what did that look like? So again, we take that chart we just saw, and if we took that housing set aside, now you can see about half of the money coming in a project area, in our case, was going to the redevelopment agency. So that's how we were funding economic development. That's how you're funding infrastructure, those kind of things. So those are all eligible costs under RDAs. And the state, they tried many different times to erode that ability to take that money. And the first major bite at that was AB 1290. And this is the Community Redevelopment Law Reform Act of 1993, which became effective on January 1st, 1994. Among many of the changes enacted by AB 1290 was the elimination of tax sharing agreements and the implementation of statutory reimbursement to all taxing entities. So mandatory reimbursement payments were required for projects adopted or amended on or after January 1st, 1994. So all the agreements that we had with those various agencies were actually enacted in 1993. So as you recall, there's the statutory ones that were identified in AB 1290, and there was the actual pass-through agreements that we had established voluntarily before that. So in 2010, Proposition 22 amended the state constitution to eliminate the state's ability to borrow or shift local revenues and certain state revenues that fund transportation programs. The measure restricts the state's authority over a broad range of tax revenues, including property taxes allocated to cities, counties, special districts, and redevelopment agencies. So, while the state could not further restrict property tax allocated to redevelopment agencies, and that was kind of the last straw, right? So 2010, keep that date in mind. But because the state was the one that enabled the creation of RDAs to begin with, that means they could also eliminate them. And that's exactly what they did. AB 1X26 or X1X26, it says X1 on the screen, I apologize. On June 29th, 2011, Governor Jerry Brown signed AB X126, which is known as the RDA dissolution bill, into law. And on December 29th, 2011, because this was instantly challenged in court, the California Supreme Court released its decision in California Redevelopment Association et al. Versus Montesantos, upholding AB X126. As a result, effective February 1st, 2012, all RDAs and community development agencies were dissolved, and successor agencies, as defined by the law, were required to be appointed to oversee the distribution of tax proceeds that would have otherwise been paid to the RDAs. The successor agencies have various legal requirements imposed on them by the legislation, and their actions are subject to the review of oversight boards, which were also created by the new law. So the now former RDAs usually had a number of existing financial and legal obligations, and some had way more than others. So most of them had like outstanding bonds. So that was the most common thing, is that you would issue these tax increment financing bonds to fund infrastructure, fund the acquisition of property. And then as that property was redeveloped and grew, then you would use that increment to pay those bonds off. So you could basically have a financing mechanism up front. So the money is set aside for those obligations. So they bring in the county controller's office or assessor, or the treasurer actually, would set aside the money plus a nominal amount for administering the former RDA's wind down affairs. And the rest of the money would go to the taxing agency. So that was basically, spelled the end. So what did that look like in terms of actual dollars? So again, here is kind of what RDAs were operating at. In Calimesa, we didn't have a huge amount of activity. We do have one bond outstanding that's being paid off. So that blue now is what's left coming to what is now called a successor agency, to pay those obligations, and the rest goes to the taxing agency. So again, that orange is all the taxing agencies. So you can see that they're made whole. And then after those obligations are paid off, we kind of go back to where we were from the beginning. And that is all the money going to the taxing agencies under that normal formula. So this was it was sold as trying to support the schools. But the reality was, it was the state wanting to discount their obligation. Because again, remember, the only ones that probably came out ahead were the non-school agencies that didn't have a 100% pass-through. So the county and the San Gregorio Pass Water Agency, in our case, were the only two. The schools didn't get anything out of it, because for every dollar that's now coming from what used to go to the RDA is now being taken away from by the state. And lo and behold, about 2 years after this law passed, the state had a huge surplus. It was partially driven by economic growth, but it was primarily driven by the fact that they could dramatically reduce the amount of money that they had to pay to schools than they did previously. So that's what it was about. So what are some of the long-term effects of RDAs being eliminated? Well, first of all, it eliminated a significant source of funds for infrastructure. That's number one. It also eliminated a significant source of funds for affordable housing, because remember, you had that housing set aside, and a lot of agencies, especially large ones, had a significant amount of money that they could invest in that, and they could utilize that to leverage other federal and state programs for affordable housing, which now they can't do anymore. It takes about 4 or 5 years for a city to now have enough money to cobble together to do an affordable housing project, where before they could probably do one every year in larger cities. So, the housing crisis that we're seeing and the decrease in the amount of available affordable housing has been driven by that. I mean, because it was a significant sum of money for that cities no longer have. But it also limits the ability of cities to more actively engage in economic development. So a lot of people, say, why doesn't the city put this in? Why doesn't the city put that in? During the RDA days, the city actually had a lot of control over that because you could go in, buy land, and then strategically sell it to the developments that you wanted. So you had more control. Not only we have land use control, so we can control commercial, industrial, residential, right? But then we were also able to have more control over the actual development and the actual businesses that win because we were the developer. The cities were developers. And again, this didn't happen largely in Calimesa. It happened in much larger cities. City of Yucaipa, for example, a big reason that Uptown Yucaipa got done was because of redevelopment. That was a redevelopment project area. And so you can use the economic development tools that redevelopment agencies made available to you to do that kind of thing. And we were on our way to that. We were on our way to do that for the downtown in Calimesa when RDAs were eliminated. So we never got to that point and we never were able to get that off the ground. We're starting to look at it again using different mechanisms, but that's what happened. So cities, I always joke that, cities don't have control over developments. Well, at one point we actually could do that. And now, because of the elimination of RDAs, we really can't do that anymore. So with that, we're going to wrap up our show. Remember, our next city council meeting is this Monday, February 3rd at 6 p.m. at the Norton Young Love Senior Center. You can catch it live in person or on the city's YouTube page by going to calimesa.gov/YouTube. A reminder, there is no regular episode next week of the podcast, but I will be bringing you some clips from the conference I'll be at, so look out for that. Subscribe to the podcast on YouTube and on your favorite podcast app, and also remember to follow me on Instagram and TikTok, both at Calimesa Insider, all one word, where you will find highlights and bonus content. So until next time, have a great weekend, and I will talk to you again in 2 weeks. Take care.